Hello everyone, welcome to GES News Today channel, where we give you the best and the latest information you can get anywhere. We are going to give you 6 major clauses you should look out for in any loan agreement before you sign. Do not be in a haste to collect your loan or to collect the money, but rather take your time and make sure that you have answers to the following clauses in the loan agreement. Otherwise, you will be committing a very grave mistake. Take it or leave it. Now, before we go right in, we are urging you to subscribe to this channel. Subscribe simply means follow on YouTube. So kindly subscribe so that when our next videos are up, for instance, comparing insurance scheme versus savings, which one is better, we're also going to consider videos for SIC GES insurance for teachers, and then My Life Nat Heritage Cashback insurance for teachers. So kindly subscribe so that when the videos are out, you will be able to see them through the notifications, or whenever you are on YouTube, you will get a signal from YouTube to listen. That is all about subscribing. There is no deduction of money from you. There is nothing like you pay money to us. No. Now let's go right in. What are the 6 main clauses you should look out for in any loan agreement you are going to pick? The very first and foremost on our list is whether the interest is flexible or it is fixed. Whether your interest is flexible or it is fixed. Before we explain, let's give you a background. Last year, when inflation was very skyrocketing and other issues in the economy were popping up, banks in the country, including Ghana Commercial Bank, they were increasing the deductions that they were making already. They increased the amounts for their customers. A lot of them got very angry as to why they have increased the deduction without their notice, and even for the fact that they have not taken any extra money, yet they have increased the deduction. The reason is simple. In every loan agreement, the interest can either be flexible or fixed. Flexible interest simply means that whenever there is any changes in the economy that needs the interest to be varied, then the financial institution or the bank is at liberty to make changes to the deduction. So they can either increase the deductions or reduce it. In this case, before they reduce it, it means the condition in the economy are improving very drastically, and for that matter, there is a need to reduce the interest. The same thing applies when the economy is not doing very well, it's very bad and changing very frequently. They also have the right to increase the deductions for you. But let's say that, or let's state that, out for reduction in the deduction, it happens rarely. It doesn't happen often. In fact, it's virtually impossible that they will reduce the deduction, because reducing means they are reducing their interest, they are reducing their profit and everything. But when they are about to lose anything, they will not give it a chance. They will definitely take the chance to increase the deduction to recoup whatever losses they think they are about to make. So, in this case, you should be interested in an interest that is fixed. No matter the nature of the economy going forward, the bank or the financial institution will not have any right to increase the deduction. Based on this, we are asking or encouraging members to make sure they read loan agreement fully, because it is only through that you can be able to see these clauses in the loan agreement whether they have met your expectations or not. Let's take the second point. What is the percentage or nature of penalty for default payment? We are in a country where salary earners can stop receiving their salary because of technical issues in the system, lack of validation, or for whatever reason your salary may stop coming. What happens if you are not able to meet your monthly loan deductions? For some banks or financial institutions, they will make sure that anytime you did not pay any loan or you did not pay any deduction for that particular month, they will consider that deduction as a principal and be charging interest on it for you up to the time you are coming back to pay that particular month's deduction plus the interest on it. They call it a penalty. However, there are some institutions they do not do that. If you are not able to pay a particular deduction for some particular number of months, it will remain flat until you get the money to pay it back just like that. So you should be interested in it, and these are some of the things you should be using to compare loans from different financial institutions. Now let's look at the third point. What is the percentage or nature of penalty for early settlement? Good. You may need a loan now, but maybe going forward, you may have the ability to pay off that loan anytime you want. It will interest you to know that some financial institutions do not take it lightly whenever you are coming to pay back the loan in full without running the full course of the duration. The reason being that the more you keep the money, the more you pay interest on it. And you coming to pay back means that you are a very good customer who they wouldn't like to part ways with. For that matter, they will usually put a penalty on the outstanding amount that you are coming to pay back. So, what is the percentage? Others charge 10%, 5%, depending on the institution, depending on the amount that is left. So you should be looking out for this particular clause. If it is not stated explicitly, kindly ask for explicit answer. Before we go to the point 4, 5, and 6, we are encouraging you again to subscribe. Let's go to point 4. The loan that you are taking, is it based on reducing balance interest basis or it is based on a flat rate? Flat rate simply means that you are coming for a loan for 3 years. They will calculate the interest on the principal that you are taking as if you are keeping the principal for all the 3 years. And then they will now add that interest to the principal and divide it by the number of months or number of periods you are going to make repayment. That is a flat rate. But for reducing balance, they consider the fact that anytime you are coming to pay back your monthly payments, deductions, you are actually paying part of the principal and then the interest. And for that matter, going forward, you should be paying interest on only the outstanding amount that is left with you. And this particular reducing balance approach ensures that the overall interest you are paying on the loan is lower than the flat rate system. Even though it is a reducing balance, they use some formulas in a way that they will divide all the amount and whatever will be paying monthly will be the same, but it is still reducing balance. The same way the flat rate system, they will do it and divide it and it will still be what? Flat rate. So you cannot just use how they did that to know whether it is flat rate or reducing unless you do some complex calculations using Excel. Now let's look at the point 5. If you are going to take a loan, what are the questions you should be asking whether they are answered in the loan agreement? One of such is whether the loan is insured or not. Now, there are two sides to a coin. If the loan is insured, what it means is that the interest will be higher, or the deductions will be higher than the ones that are not insured, because the insurance premium for the loan would be captured as part of the loan deduction, because they cannot be charged you separately for loan insurance separately. Everything is worked inside. If it is not insured, the deductions will be less. But due to the nature of a Ghanaian, due to the nature of how people consider money and treat it, many of the loans are insured. They are insured to avoid any runaway. Now let's look at the point 6. Now with the point 6, what will be the obligation on the parts of the guarantor? Sometimes you are going for a loan, they will ask you to get a guarantor. What are the obligations? Is the guarantor going to be liable to pay the money in case the one who took the loan is incapacitated or is not alive? Good. So if the person is not alive or is incapacitated, why would the guarantor be made to pay back this money? However, if the one who is taking the money is well and kicking and alive, but is unable to pay the loan, what then still is the obligation on the parts of the guarantor? Many of the insured loans do not need guarantors, even though they will have ways and means of threatening you or trying to gather information that means that you are not going to abandon the loan. But many of the insured loans do not need guarantors. Or if they need guarantor, the amount of money on the insured part is less. So in short, these are the 6 clauses you should be looking out for in any loan that you are going to take. And make sure that you subscribe to be able to see our next videos when they are out. Bye bye.